If oil hits $120 per barrel, here's what happens to every TSP fund. Oil is climbing again. As of this morning, Brent crude is sitting in the high 70s, and we are now having a very real conversation about what happens if it keeps going, if it pushes past 100, if it touches 120. And I know what you are thinking if you are a federal employee watching this. You are not thinking about global geopolitics right now. You are thinking about your TSP. You are thinking, does the C fund drop? Does the I fund get crushed? Does the F fund actually benefit from this? And should I be moving to the G fund before things get worse? Those are the right questions. And today we are going to answer all of them. But here is what we are not going to do. We are not going to panic. We are not going to react to a number on a screen. We are going to do something more useful than that. We are going to model outcomes. I am going to walk you through exactly what happens to each TSP fund in an oil at 120 environment. Not based on gut feel, based on historical data, macroeconomic mechanics, and the actual analyst forecasts that are on the table right now. Why $120 oil is a different kind of event. I want to start by explaining why $120 per barrel is not just a big number. It is a threshold that changes market behavior in a very specific way. Here is the rough framework that energy analysts use when they think about oil prices and their economic impact. Oil in the 60s and low 70s, that is manageable. Markets are comfortable. Inflation pressure is present but not alarming. Oil in the 80s to low 90s, concern starts building. Airlines are hurting. Consumer energy bills are rising. The Fed is watching. Oil in the 90s to 100, markets start repricing. Inflation expectations tick up. The question of whether the Fed will delay rate cuts becomes real. Oil above 110 to 120, that is when the narrative shifts from inflation concern to demand destruction. That is when analysts start using the word recession. And right now, today, JP Morgan has specifically warned that Brent crude could hit 120 per barrel if the current Middle East conflict leads to a sustained disruption through the Strait of Hormuz. That is not a fringe forecast. That is JP Morgan Chase. So why does 120 matter so specifically? Because oil is embedded in literally everything. And I mean everything. This is the part people underestimate. When they think about oil prices, they think about the gas pump. But oil prices are much broader than that. It flows into transportation costs. That means every product you buy gets more expensive to ship. It flows into food, fertilizer, pesticides, farm equipment, refrigerated transport. Your grocery bill reflects oil prices. It flows into manufacturing, plastics, packaging, industrial energy use. It flows into airline tickets. Anytime oil spikes, airfares follow within weeks. It flows into utilities, electricity generation, heating costs. When oil hits 120, you are not just paying more at the pump. You are seeing a broad systemic increase in the cost of living that shows up across almost every category of consumer spending. And here is what that does to the Federal Reserve. The Fed was expected before all of this to be cutting interest rates in 2026. Analysts were pricing in another 25 to 50 basis points of cuts by mid-year. That is good for equities. That is good for bonds. That is good for your TSP. But an oil shock at 120 flips that script. One analyst I read this morning described it perfectly. An oil shock at this level is a classic supply-side inflation driver that directly complicates the Federal Reserve's dual mandate. The Fed cannot easily cut rates when inflation is being pushed higher by an energy shock, so the rate cuts either get delayed or canceled, and that changes the valuation equation for nearly every asset in your TSP. That is the macro context. Now let's talk about the chain reaction in the markets. Let me model this out for you the way a strategist would, step by step. Step 1, oil hits 120, not a gradual grind, a spike, possibly within days of a confirmed sustained supply disruption. Tanker traffic through the strait has already effectively halted. Brent crude is already in the high 70s. The gap to 120 is not as far as it might seem. Step 2, energy stocks surge. This happens first and fast. Exxon, Chevron, ConocoPhillips, energy ETFs. Oil producers are immediate beneficiaries of higher crude prices. Their margins widen, their revenues increase. Investors rotate into them. For the C fund, which tracks the S&P 500, energy is a component of the index. So there is a partial cushion here. But I want to be very clear. Energy is not a dominant enough weight in the S&P 500 to protect the broader index from a serious oil shock. It blunts some of the damage. It does not absorb it. Step 3, airlines and transportation get hit hard. Fuel is one of the single largest line items for airlines, shipping companies, and logistics firms. When oil spikes, their cost structures blow out immediately. You see swift and significant sell-offs in those names. We are already watching 4 vessels get hit in Gulf waters in the last 3 days. Shipping companies and their insurers are refusing to route through the strait. Insurance premiums for war risk coverage have surged. That cost gets passed somewhere. Step 4. 2 competing fears emerge simultaneously. This is the most important thing to understand about a major oil shock. It creates 2 fears at the same time that pull markets in opposite directions. Inflation fear says oil is pushing prices higher across the whole economy. The Fed cannot cut rates and maybe has to raise them, so equities and bonds both face pressure. Recession fear says oil at 120 is going to slow economic activity, reduce consumer spending, crush corporate earnings, and tip us into a downturn. In the early stages of a shock, inflation fear tends to dominate. Investors are reacting to the immediate price data. As the shock persists, recession fear starts to take over, because markets start pricing in what demand destruction actually looks like. Which fear is winning right now? As of this morning, energy traders are actually describing the market as measured, not panicked. Brent is in the high 70s, a big move from Friday's close of about 72. But not 120, not yet. The question for your TSP is, what happens in the scenarios where it actually gets there? Step 5, global equities and currency markets reprice. Gold is rising. That is a flight to safety signal. The US dollar is strengthening. Also, a classic flight to safety move. European equities are already down roughly 1 to 1.5% in early trading. Euro Stoxx X futures, DAX futures, FTSE futures, all negative. S&P 500 futures and NASDAQ futures lost about 0.8% at the open. That is the early read. Now let's translate all of this into specific fund-by-fund impact. What is the C fund impact at oil $120? The C fund tracks the S&P 500. It is most federal employees' largest TSP allocation. So let's spend real time here. In an environment where oil is at $120, the C fund faces 3 distinct crosscurrents. Crosscurrent 1, an energy sector lift. Energy companies make up roughly 4 to 5% of the S&P 500. When oil spikes, those names surge. That is a genuine partial offset for the index, not enough to save it from a major shock, but it is not nothing. Crosscurrent 2, broad earnings pressure. When oil is elevated for months, input costs rise across the entire economy. Airlines, manufacturers, consumer goods companies, shipping and logistics firms, their margins compress, their earnings guidance gets cut, and markets reprice stocks based on lower expected earnings. Historically, oil shocks that do not trigger a recession produce mid-single-digit corrections in the S&P, something in the range of 5 to 8% from peak. That is painful, but it is recoverable, especially if you are still accumulating. Oil shocks that do trigger a recession, those produce corrections in the 15 to 25% range, sometimes deeper. Crosscurrent 3, the Fed variable. This one is specific to right now, and it matters enormously for the C fund. Going into this weekend, markets were pricing in Fed rate cuts in 2026. Rate cuts are fuel for equities. They reduce the discount rate applied to future earnings. They make stocks look more attractive relative to bonds. An oil shock at 120 potentially removes those cuts from the table entirely. If inflation expectations re-anchor higher, the Fed sits on its hands. Maybe for 6 months, maybe for the rest of the year. When the rate cut narrative dies, equities lose a significant source of support. So the C fund at oil 120 is facing partial energy sector cushion, offset by earnings pressure across the broad economy, compounded by potential loss of Fed rate cut support. Net result, meaningful short-term volatility, a potential 5 to 10% drawdown if the shock is prolonged. Deeper if recession fear takes over the narrative. Historical recovery after geopolitical shocks. Most shocks that do not escalate into multi-month supply disruptions see the S&P recover within 3 to 6 months. The June 2025 playbook is instructive here. When Israel struck Iran's nuclear facilities, the S&P sold off sharply at the open. Then they recovered the same day, once markets confirmed the strait had not been disrupted. That is the template traders are watching right now. What is the S-Fund impact with oil at $120? The S-Fund tracks small cap US stocks, and small caps in an oil at 120 environment tend to feel it worse than large caps. Here is why. Small companies have thinner margins. They do not have the pricing power of an Exxon or a Procter and Gamble to pass higher costs along to customers. When input costs spike, smaller companies absorb more of that hit. Small caps also carry more debt relative to their size in many cases and at floating rates. If the oil shock is delaying Fed rate cuts or even raising concerns about whether rates go higher again, the debt burden on smaller companies gets heavier, and small caps are more economically sensitive in general. They tend to be more domestically focused businesses with less ability to diversify their revenue streams globally. When the US economy slows because consumers are spending more on energy and less on discretionary items, small caps feel that contraction first and most. In market terminology, the S fund has higher beta. That means it amplifies the moves of the broader market in both directions. If the C fund drops 5%, the S fund might drop 7 or 8%. If the C fund drops 15% in a recession scenario, the S fund could be down 20 to 25. But the flip side is also true. When the recovery comes, small caps often bounce harder and faster than large caps. For long-term accumulators who are years away from retirement, S fund volatility during an oil shock is uncomfortable. It is not catastrophic. The ability to keep contributing through that volatility is an advantage. For investors closer to retirement who have a heavy S fund tilt, this is worth reviewing, not out of panic, out of alignment with your actual risk tolerance and time horizon. Now, what is the iFund impact with oil at $120? The iFund tracks international developed market stocks, primarily Europe and Japan, with some exposure to other developed economies. And here is the uncomfortable truth about the iFund in an oil at 120 environment. It is your most exposed equity fund. Let me explain why with some specifics that are directly relevant to what is happening right now. 1. European energy dependence. The United States has become a significant oil and natural gas producer over the past decade. The shale revolution changed the country's energy position fundamentally. When oil prices spike, the US is not purely a victim. It is partly a beneficiary. Europe is not in that position. European nations are substantial energy importers. They depend heavily on LNG shipments that flow through the Strait of Hormuz. The European natural gas stockpiles, by the way, are depleted right now. One analyst specifically called this out this morning as a reason European energy prices are reacting more acutely than US prices. When oil and natural gas costs spike for European manufacturers, factories, and consumers, the economic pain is disproportionately larger than in the US-European economic growth already faces headwinds. An energy shock at this level makes a European recession significantly more likely. We are already seeing this in the early market data. Euro Stoxx 50 futures are down more than 1%. DAX futures, which track the German industrial economy and its heavy manufacturing base, are down even more. 2. The currency double hit. There is a second layer of pain for iFund investors specifically, and it has to do with currency. In a risk-off environment, the US dollar tends to strengthen. Investors around the world want the safety of dollar-denominated assets. They sell euros, yen, and other currencies to buy dollars. For a US investor holding international stocks through the iFund, a stronger dollar is a headwind. Why? Because those foreign stock gains, when they get converted back into dollars, are worth less. You can have a stock in Germany go up 2% in euro terms, but if the dollar strengthened 3% against the euro during that same period, you actually lost money in dollar terms. So the iFund faces the double hit in a sustained oil shock. Weaker underlying stock markets in energy import-dependent economies and currency headwinds from a strengthening dollar. 3. The LNG wildcard. There's one more thing worth flagging here. Qatar is the second largest exporter of liquefied natural gas in the world, right behind the United States. Nearly all of Qatar's LNG exports move through the Strait of Hormuz. Japan, South Korea, and large parts of Europe depend on Qatari LNG to power their economies. If the Strait disruption continues, those economies are not just paying more for energy. They are facing potential energy shortages. That is not a market volatility event. That is a structural economic shock that could last quarters, not weeks. Bottom line on the iFund, in a temporary oil spike scenario, the damage is real but recoverable. In a sustained disruption scenario, the iFund faces the deepest and most prolonged pressure of any equity fund in your TSP lineup. What about the F-Fund impact? The F-Fund tracks a broad U.S. investment grade bond index, and its reaction to an oil shock is genuinely the most nuanced of any fund we are going to discuss today. Here is why. The F fund does not react to oil prices directly. It reacts to what oil prices do to interest rate expectations, and those expectations can move in two completely opposite directions depending on which fear wins the market narrative. Path 1, inflation, fear dominates. If oil at 120 causes inflation expectations to surge, bond markets will price in a scenario where the Fed cannot cut rates and might even need to raise them again. In that case, Treasury yields rise. And when yields rise, bond prices fall. The F fund loses value. This is the early stage reaction. When oil first spikes, inflation fear tends to dominate. The immediate concern is what this does to CPI data in the next 2 to 3 months. Path 2, recession fear dominates. If oil stays elevated long enough that economic growth starts visibly slowing, the narrative shifts. Investors start pricing in recession rather than inflation. In a recession, the Fed cuts rates aggressively to stimulate growth. When rate cut expectations return, Treasury yields fall, and when yields fall, bond prices rise. The F fund benefits. This is the later stage reaction. Historically sustained oil shocks that last more than 3 to 4 months tend to shift the dominant fear from inflation to recession. So here's the practical guidance for the F fund. In the early weeks of an oil shock, the F fund faces headwinds from rising inflation expectations. If you are watching the market closely, you will likely see the F fund decline modestly in this phase. As the shock persists and recession concerns build, the F fund starts to look more attractive as a defensive holding, not because bonds are immune to economic disruption, but because falling yields are a tailwind for bond prices. The nuance here matters for federal employees who are thinking about whether the F fund provides shelter in this environment. The answer is, it depends on timing and which narrative is driving the bond market in any given week. Let's talk about the G fund, the safe haven with a behavioral trap. Let's talk about the G fund, because this is the conversation I most need to have with you right now. The G fund is backed by U.S. government securities. Its value does not go down with market volatility. It earns a steady return based on Treasury rates. In a world where every other fund is swinging around, the G fund sits there quietly, doing nothing dramatic in either direction. I completely understand why it is psychologically attractive right now. When I look at the headlines today, I get why federal employees are tempted to just move everything over and wait until this blows over. But I need you to understand the behavioral trap hidden inside that instinct. The timing problem. Here is what typically happens. Oil spikes, markets drop, federal employee sees their TSP balance drop, panic builds, they move to G. And then one of two things happens. Either the shock resolves quickly, like June of 2025, markets bounce back within days, and the federal employee who moved to G locked in their losses and missed the entire recovery. Or the shock persists, markets grind lower, and they feel validated for a few weeks before eventually moving back into equities, usually after missing the initial leg of the recovery. Moving to G after a drop has already happened is almost always a mistake, because at that point you have transformed a paper loss into a real one when the G fund is actually appropriate. The G fund is appropriate as a ballast, as a stabilizing portion of your allocation if your overall portfolio is already calibrated to your actual risk tolerance and time horizon. If you are 5 to 7 years from retirement, having a meaningful G fund allocation is not fear-based. It is appropriate. That allocation should have been there before this weekend. If you are 15 to 25 years from retirement and fully in G because you are scared right now, that is almost certainly going to cost you a significant amount of long-term wealth. The question to ask yourself is not, am I scared right now? The question is, does my current TSP allocation match my actual time horizon and retirement goals? If yes, hold it. If no, rebalance to your target, not to fear. Okay. This is the section that separates reactive thinking from strategic thinking. We are going to model 3 scenarios, and for each one, I'm going to tell you what the environment looks like, what your TSP funds will likely do, and what the appropriate response is. Scenario A, oil touches $120 and retreats. What this looks like, oil spikes sharply over the next week or two, possibly approaching or briefly touching the 120 level, but then one of the following happens. Either the US and Iran reach a preliminary agreement to talk, or the U.S. Navy successfully escorts tankers through the strait, proving the closure is not sustainable. Or OPEC production increases materially offset the supply loss. The conflict does not expand to a multi-month sustained engagement. What markets do? Risk-off spike, S&P drops 3 to 7%. I fund gets hit harder, dollar strengthens, gold rises. Then, as de-escalation signals emerge, most of those moves partially retrace. Markets recover within 2 to 4 weeks. What Citi specifically said this morning, Brent trading between 80 and 90 in the base case, pulling back to about 70 on de-escalation. That is scenario A territory. What you do, nothing emotional. You hold your allocation, you continue your regular contributions, you rebalance to your target if the volatility has shifted your fund percentages meaningfully away from your intended split. You do not touch your IFTs reactively. This is historically the most common outcome for geopolitical oil shocks: quick spike, quick recovery. Scenario B, oil holds above $110 to $120 for 3 to 6 months. What this looks like: the conflict in the Middle East does not resolve quickly. Combat operations continue for weeks. Tanker traffic through the strait stays disrupted. Oil stays elevated. Goldman Sachs has already estimated an $18 per barrel risk premium embedded in current crude prices. If the conflict extends, that premium stays and possibly grows. Inflation expectations tick higher and stay higher. The Fed pauses its rate cuts. Markets enter a choppy, volatile sideways period. Not a catastrophic crash, but months of unsettled conditions. What markets do? Equity indices are down 5 to 15%. International markets face deeper pressure. Bonds are choppy, depending on whether inflation fear or recession fear dominates in a given week. Defensive assets like gold continue to perform. What you do? You stay disciplined. You resist the urge to make emotional IFT moves. You continue contributions because you are buying through the volatility at lower prices. If your allocation has a heavy I fund or S fund tilt that is out of alignment with your actual time horizon and risk tolerance, this is a moment to thoughtfully rebalance toward your target. Not to flee, to calibrate. You also think about this. Your pension is a bond-like asset. It provides stable, predictable cash flows in retirement, adjusted for inflation, for life. That asset does not lose value because oil spiked. Your TSP drawdown in scenario B is real. It is not your whole picture. Scenario C, sustained supply disruption and recession triggered. What this looks like: this is the tail risk. The low probability, high impact outcome that the serious analysts are flagging. The strait remains effectively closed for months. Tanker traffic does not resume. Iraq is forced to curtail production because it cannot export through the strait. Saudi Arabia and the UAE have their export capacity stranded. Woodmac has specifically warned that OPEC's spare capacity becomes inaccessible in this scenario. Oil stays above 120, possibly moving toward the Societe Generale extreme case of 120 to 150. Global inflation surges. Consumer spending contracts sharply. Corporate earnings miss across the board. The global economy tips into recession. What markets do? Equities correct significantly. We are talking potential 15 to 25% drawdowns. International markets face the deepest cuts. Small caps are disproportionately hit. The F fund eventually benefits as recession fear dominates and yields fall. Gold continues to be a safe haven. What you do? Now defensive positioning is not just appropriate, it is warranted. A meaningful G fund allocation as a ballast makes sense. The F fund in the later stages, when recession fear has fully taken over, becomes a reasonable defensive allocation. You are not abandoning equities entirely, but you are acknowledging the severity of the scenario and adjusting accordingly. And critically, if you're going to make that defensive move, you want to do it before the full market pricing of a recession has played out, not after a 15% decline has already happened. Because at that point, you are locking in the loss and risking missing the recovery. Scenario C requires actual, confirmed, prolonged supply disruption, not radio broadcasts, not threatening gestures, not 1 week of tanker avoidance, months of genuine supply loss from the region. We are watching to see if that is where this goes. So what should federal employees actually do? Let me be straight with you about what I think you should actually do right now. First, do not make any TSP moves this weekend while you are watching scary headlines. That is the worst decision-making environment possible. Wait until Monday's market open. Let the initial reaction happen. Watch whether oil stabilizes or keeps climbing. That will tell you a lot about which scenario you are tracking. Second, know your triggers for each scenario. Here's a simple framework. If oil is back below 90 by the end of next week, you are most likely in scenario A. Hold your allocation. Keep contributing. If oil is still above 100 to 110 by the end of next week, and combat operations are still ongoing with no diplomatic progress, you are tracking towards scenario B. Thoughtfully review your allocation relative to your target. Calibrate if needed. Do not panic sell. If oil pushes above 115 to 120 and tanker traffic through the strait has not materially resumed after 2 to 3 weeks, scenario C risks are becoming real. Now it is appropriate to evaluate a more defensive posture. Not all in on G, but a meaningful defensive adjustment. Third, keep contributing. Whatever happens to your allocation, please do not stop your TSP contributions, not ever, but especially not now. Contributions made during a drawdown, buy more shares at lower prices. Those shares compound for decades. Stopping contributions during market stress is how you give away future wealth. Fourth, remember your actual picture. You have something most private sector workers would genuinely give anything to have: a federal pension, a defined benefit, stable income, and retirement that does not depend on what oil does this week. Your TSP is your growth engine. It is supposed to swing around sometimes. That is the cost of admission for the long-term returns that make it worth holding. The key is that you are in it for the right duration and with the right allocation for your actual situation. An 8 to 10% TSP drawdown because oil spiked is not a retirement catastrophe. It is a normal market event happening in your growth engine while your pension, your steady contributions, and your long-time horizon continue to work in your favor. Stay in the system. Think in scenarios. Act on data, not fear. Here is what we covered today. Oil at 120 is not a random number. It is the threshold where inflation becomes stagflation risk, where the Federal Reserve's rate cut narrative gets derailed, where demand destruction and recession concerns enter the conversation in a serious way. For your TSP, the C fund faces meaningful but historically recoverable volatility with a partial energy sector offset. The S fund amplifies that volatility because of its higher beta nature. The I fund faces the deepest exposure because European and Asian economies are disproportionately energy import dependent, and currency headwinds compound that pain. The F fund reaction depends on which fear wins: inflation in the early stages, recession in the later stages. The G fund is a ballast, not an escape hatch. There are three scenarios: a temporary spike and recovery, a prolonged period of elevated oil and choppy markets, and a sustained supply disruption that triggers a broader recession. Each scenario has a different appropriate response, and your job is to watch the signals and know which one you are actually in. If you want to go deeper on stress testing your specific TSP balance against each of these scenarios, I am building the tools inside FireFed to let you do exactly that. Input your balance, your allocation, your time horizon, and see what the numbers look like under oil at 120, inflation at 5%, delayed rate cuts, and a 15% market drawdown all at once. The link is below.
But for now, here is what I want you to take away from this video. Volatility is temporary, compounding is permanent, and the federal employee who thinks in scenarios instead of reacting to headlines will always come out ahead. I will see you in the next one.